Welcome to the Endocrine Matters podcast. This podcast episode is sponsored by Complete Medicine and Hey Healthy. Welcome back to Endocrine Matters. I'm Dr. Arti Thangudu. Today, I want to talk to you not just as a physician, but as a small business owner, an employer, and a person who has to buy health coverage for myself and others. We're going to talk about something that is terrifying a lot of people right now. Health insurance premiums are jumping 40, 50, even 500% as the Enhanced Affordable Care Act subsidies are rolled back. If you're an individual buying your own plan, or a business owner trying to cover your team, you may have opened your renewal and felt your stomach drop. For some people, the new premium is literally more than their mortgage. For others, it's forcing conversations like, do I shut down my private practice to get a job with benefits? Do we give up our coverage and just pray nothing catastrophic happens? Do we get divorced on paper to qualify for subsidies? These are not theoretical questions. These are real decisions people are facing right now. And I want to say this clearly at the top of the episode. You are not crazy. You are not alone, and this is not your fault. What I also want you to hear is this. There are alternative strategies that can protect you, your family, and your employees. They're not perfect. They require learning, intention, and sometimes a little courage to leave the default system, but they do exist. So in this episode, we're going to cover three big things. One, why premiums are exploding for individuals and businesses as ACA subsidies are pulled back. Where your money is actually going when you pay those premiums. And we'll talk about concrete solutions that almost no one is talking about, like medical cost sharing options like Sedera for catastrophic events, like direct care with transparent cash-based pricing for everyday care, also with negotiated lab and imaging pricing. We'll also talk about self-funding strategies for employers and how to become a better steward of your healthcare dollars. My goal is not to make you an insurance expert. My goal is to help you see that you are not powerless. Let's start with what's happening right now. So why are premiums suddenly exploding? For a few years during and after the pandemic, many people with ACA plans got a bit of a break. Congress temporarily enhanced ACA premium subsidies. That means people with lower incomes could often get plans for very low or even zero premiums. Middle-income families who used to earn too much for help suddenly qualified for assistance. Those enhanced subsidies made coverage feel barely manageable for millions of households and small business owners. Now those enhanced subsidies are expiring. At the same time, insurers have filed some of their steepest rate hikes since 2018. And as we know, right now, it's November of 2025 and Congress is deadlocked. We've even had a government shutdown tied to this fight over whether to extend those subsidies. So you get a double whammy. Base premiums go up and insurers are raising prices. Your subsidies go down or disappear, so you feel 100% of that increase. That's how we get to people seeing 40, 50, even 500% increases in their out-of-pocket premiums. Let me put some faces to this because it's not just numbers. A 57-year-old therapist in Texas on an ACA plan sees her premium jump from about $862 per month to $1,380 a month, and she's told she likely won't qualify for subsidies next year. She's genuinely considering closing her private practice where she serves sexual assault survivors just to get a job with benefits. What else? A 63-year-old woman battling lung cancer sees her subsidized premium go from just manageable to completely unaffordable. She's staring at the possibility of being uninsured while needing scans every 3 months to detect recurrence. Or an older couple in their early 60s is told their premium will be nearly half their income. They ultimately decide to drop coverage entirely and simply hope nothing catastrophic happens. There are countless stories like this, and when you zoom out, a few patterns become clear. People in their 50s and 60s get hit the hardest. They already pay more, and the loss of subsidies magnifies that dramatically. Middle-class families and self-employed professionals suddenly make too much to get help, but nowhere near enough to comfortably absorb a $1,500 to $2,000 monthly premium. Small business owners are seeing renewal quotes that are 40 to 100% higher than last year. Some are getting quoted increases over 300 or 400% when they try to keep similar benefits. This is how you end up with a business owner whose group plan quote jumps so much that covering employees would literally wipe out their profit or even push them negative. The standard story is, well, medical costs are rising, hospitals and drugs are more expensive, utilization of healthcare needs is up. Of course, premiums go up. But if that were the only story, you would expect to see all the extra money you're paying going to doctors, hospitals, and medications. But that's not what's happening. Where is your premium actually going? Well, let's follow the money. Since the ACA was implemented, premiums have roughly doubled on the exchanges, and deductibles for common silver plans have risen close to 92%. You are paying more every year for less financial protection. Health insurers will tell you it's just higher medical costs and utilization. And yes, healthcare is expensive. That is real. But when we look at the financials of the largest insurers, a very different layer appears. From 2014 to 2024, the 7 largest publicly traded health insurers, you know the names of them, reported more than $500 billion in profits. $500 billion. In just one recent year, they made around $71 billion in profit, and their CEOs took home over $140 million combined. This is profit made from your premiums, the premiums you pay as an individual, the premiums your employer pays on your behalf, and the tax dollars funneled through Medicare, Medicaid, and ACA subsidies, your tax dollars. Now, what are they doing with all that profit? Well, a huge chunk goes to stock buybacks, insurers using your premium dollars to buy back their own shares and boost stock prices, which directly benefits executives and shareholders. Analysts estimate these big insurers spent on the order of hundreds of billions of dollars on stock buybacks over the last decade. That money does not lower your premium, expand your network, so increase your access to more doctors, or increase what's paid to your doctor. It just enriches shareholders. Those shareholders are not in the hospital or the clinics. On top of that, since 2014, the big insurers and their trade group have spent hundreds of millions of dollars on lobbying, over $600 million by some estimates. That lobbying money is used to shape regulations, block reforms that would cap premiums or limit the insurers' profits, and preserve the very system that is crushing patients and employers. So the money that you're spending on your premium is going to lobbies to raise your premium. So when we ask, where is all this money going? The answer is, a meaningful portion is going anywhere but your care. Here's the sobering reality. There is already enough money in the system to cover everyone better. The problem is how that money is being used. So when ACA subsidies are removed and premiums spike 40, 50, 500%, it's not because we suddenly don't have enough money. It's because families are being asked to cover more of a system that is siphoning off huge amounts of profit and politics. And this brings us to an important mindset shift. If the traditional insurance model is designed to extract maximum dollars while delivering minimum usable coverage, minimal services when you're sick, then staying inside that model and hoping it gets kinder is not a strategy. We need different tools. We need to be looking at this differently. If you are a business owner, here's what this all looks like from your side. Renewal arrives. The same plan design you had last year is now 30 to 70% more. Your broker shrugs and says, medical trend, specialty drugs, more utilization, that's what it's for. Your broker who is likely paid a percentage of your increased premium by your insurance company. That's what they tell you. They profit off your premium increase too. If you try to keep your contribution stable, employees are furious because their share and deductible go up. If you try to preserve the benefit, your profit margin disappears. A lot of small practices, especially independent clinics, mental health practices, dental offices, small professional firms, are being pushed into impossible choices. 1, drop coverage altogether. 2, move to a very high deductible plan or a junkier plan. Freeze hiring or cut wages. Or sell to a larger system just to survive. This is also happening to self-employed people. therapists, consultants, coaches, small town business owners, entrepreneurs. They're in the individual market. Watching their ACA premiums go from hundreds to well over 1,000 per month, many of them are now paying more for health insurance than they do for housing. And remember, these aren't platinum, zero deductible, everything covered plans. Often they're narrow networks, $8,000 to $10,000 deductibles. So that's how much you have to pay before the insurance kicks in, and huge out-of-pocket exposure. So this leads to a very natural question. If I'm going to pay $20,000 a year for something I'm still scared to use, is there a better way to structure this? Remember, health insurance is not healthcare. You're paying a premium regardless of whether you go to the doctor at all. So we're going to talk about that for the rest of this episode. What are other options? The good news is that you are not stuck with just one model. Here's the part that almost nobody is explaining during open enrollment. You are not limited to traditional fully insured group coverage or an ACA plan that just exploded in price. Are there trade-offs? Absolutely. Should you understand this? Yes. But there are real alternatives and combinations that can protect you from catastrophic events, dramatically reduce your monthly spend, and give you better access to actual care instead of just coverage on paper. I want to walk through three big categories. Medical cost sharing for catastrophic events like Sedera, and no, I'm not paid by them. Direct care and transparent cash pricing for everyday care, labs, and imaging. Self-funding and creative plan design for employers. And at the end, I'll talk about how to start exploring these without feeling totally overwhelmed or that you have to do it all by yourself. Let's start with something that is not insurance, but for the right person can be a powerful tool, and it is medical cost sharing, also sometimes called health sharing. One example is a company called Sedera. Sedera is a non-insurance medical cost sharing community. Members contribute a monthly share into a common pool. When a member has a large unexpected medical need, they submit the bills, the member submits the bills on their own to Sedera, and the community shares those costs according to agreed upon guidelines. A few important points about this: it is not regulated like insurance. It often has limitations on pre-existing conditions, maternity, and certain types of care. Why am I bringing it up at all? Because for some people, especially those who are relatively healthy, and that's many people, people who don't qualify for meaningful ACA subsidies, also many people who are being quoted $1,500 to $2,000 plus a month for traditional coverage, cost sharing can be a way to protect themselves from catastrophic events like cancer, trauma, major surgery, while dramatically lowering their monthly premium. With cost share programs, you can pay a much lower monthly premium just in case of a catastrophe, and pair that with direct primary care or other cash-based, transparently priced services if you do have a need from day to day. So the typical structure of this cost share plan is that you choose an initial unshareable amount of like $500 to $5,000. You choose. So you can kind of think about it like a per event deductible. You pay a monthly share, which is a fraction of an ACA premium. Think like $200 per month for an individual. And then if a big health event happens, you pay your initial unshared amount, that $500 to $5,000 that you chose, and the rest may be shared by the community subject to their guidelines. I've actually used this personally and it works. You just have to be on top of your own medical bills and submit them when needed. So the pros: much lower monthly costs than many ACA or employer plans, especially those without subsidies. The freedom to go to any provider. There is no network. I, as a physician, love this. I want to see the doctors that I want to see. I don't want to see them because they are in my insurance network only. These often pair very nicely with direct primary care. We talk more about what direct primary care is in another episode, and I'll link that. And the cons: these do matter. So pre-existing conditions, ongoing cancer treatment, and certain chronic medical needs may not be fully shareable. Some cost-sharing organizations have had serious issues, like denied large claims, limited payments, or mismanaged funds, but the same is true for traditional insurance. So I'm not saying everyone should drop their ACA plan and jump to cost sharing. What I am saying is, if your ACA or small group premium has become completely impossible and you are otherwise looking at being totally uninsured, Then a reputable cost-sharing model like Sedera, paired with direct primary care and transparent cash pricing, can be vastly better than nothing for many families. It is especially worth exploring if you're self-employed or own a small business. You are relatively healthy right now. You understand that this is a catastrophic solution, not a day-to-day comprehensive coverage. You are willing to negotiate and manage your healthcare expenses. This might seem like a huge lift, but once you get used to it, you can save thousands and thousands of dollars every year and contribute to that to a health savings account. The second pillar is one I'm deeply involved in, direct care. Direct care, whether direct primary care or direct specialty care, flips the script from pay an insurer, hope they approve something, to pay your doctor directly and know what you're getting. Models vary, but typically you pay a monthly membership for ongoing access to your physician or clinic. Visits are included. You have transparent pricing on additional services. Most clinics negotiate cash prices on labs, imaging, and medications that are far lower than what you'd pay with insurance. You'd be surprised how low lab prices are. It still shocks people to learn a lab test that bills at $200 might be $6 cash. An MRI that retails at $5,000 may be $400 with a direct contract. Generic medications can be pennies on the dollar when you're not forced through PBM markups. When you strip out insurance company overhead, PBM games, network pricing, and billing complexity, you can often provide 80 to 90% of the care people actually use in a year at a small fraction of what they're paying in premiums. Remember, premiums are not healthcare. So one powerful strategy is use direct care for primary care, chronic disease management, and many specialty needs. Use cash-based labs and imaging through negotiated discounts through your direct care providers. Pair this with catastrophic backstop, whether that's a very high deductible ACA plan if you still qualify for some subsidy, or a medical cost share community. For many individuals and small businesses, this combination can cut their total annual spend, dramatically improve access and continuity with a real doctor, and reduce the stress of, can I even afford to use my insurance? It can prevent people from going to the ER and hospitals where cost containment is a fantasy. Let's be real, you cannot contain the cost once you go to the hospital. So now let's talk about self-funding and creative plan design for employers. So for the employers listening, especially those with 10, 20, 50, or 100 plus employees, if you are still on a fully insured plan where you pay a flat premium per employee and the insurer keeps the difference, you are often overpaying in good years and still getting crushed in bad years. An alternative is self-funding. In a self-funded plan, you as the employer take on the risk of your group's claims up to a certain amount. You buy stop-loss insurance above that level to protect against catastrophic claims. You work with a third-party administrator instead of a traditional carrier. You can design networks, incentives, and benefit structures that fit your population, including steering toward direct care and transparent cash pricing. Why consider this? Because when your employees use less expensive, more rational care options, you and your team actually benefit from the savings instead of just sending those savings to United Healthcare or Cigna's profit column. For example, a self-funded employer can cover direct primary care memberships for all employees. They can waive deductibles for high-value care, like using a cash price imaging center instead of a hospital outpatient MRI, which saves the payer, aka the employer, thousands of dollars. With self-funding, employers can use transparent PBMs or cash-based pharmacy solutions so that your employees are not overpaying for medications, and neither is the company. You can build in incentives for employees to choose cost-effective care that actually serves their needs better. In years where claims are lower than expected, employers often keep the difference or reinvest it in richer benefits. Self-funding is not right for every single employer. Very small groups may not have enough stability in their claims. It requires a good advisor and a willingness to think differently. It requires high-level executives to think out of the box and be involved in their employees' health plan. If you're a mid-sized employer being quoted 30 to 60% increases in renewals, and your broker has never brought up self-funding, that's a red flag. You owe it to yourself and your employees to at least get a second opinion from someone who specializes in these alternative structures. Okay, now let's talk about becoming a better steward of your healthcare dollars. I want to zoom out and talk about mindset. For decades, we've been taught healthcare is too complicated. Just pick a plan from the menu and hope you don't get sick. That passivity is exactly what the current system depends on. We are now in a moment where that approach is no longer viable. Premiums are too high. Deductibles are too high. The old defaults are breaking. The good news is you can learn this. You do not need a degree in actuarial science, but you do need to start asking new questions. If you're an individual or a family, you need to know this stuff. You need to know, what is my total annual spend on premiums plus out of pocket? What care did I actually use last year? Would a mix of direct primary care plus catastrophic backstop be safer and more affordable than expensive high deductible insurance only on paper? If you're an employer, where is every dollar of our health benefit money going? How much of it actually buys care for employees versus profit, admin, and brokers' commissions? Have we explored self-funding? Have we thought about reference-based pricing? Could we pair direct care and cost sharing for certain segments of our workforce? You know that not every employee needs to have the same plan, right? If you're a clinician or practice owner, we need to think about this. Are we unintentionally trapped in a system that's bankrupting our patients? Could we design direct care offerings, bundled pricing, or employer partnerships that serve people better and cost them less? Being a good steward of healthcare dollars isn't about being cheap. It's about making sure your money buys actual health and care, not just paperwork, lobbying, and stock buybacks. So let's talk about practical next steps. Let me leave you with some very concrete next steps depending on who you are. If you're an individual or family, run the numbers. Look at your total annual premium plus deductible exposure on your current or proposed ACA plan. Explore alternatives if your premium has doubled or tripled. Look at direct primary care practices in your area. Look at cost-sharing options like Sedera, and understand the risks and limitations clearly. Consider high-deductible catastrophic plans paired with direct care. And ask every provider, what's the cash price? You will be shocked how often paying cash is cheaper than using your insurance. If you are a business owner, ask your broker, show me a self-funded option and show me exactly where our money is going. Talk to direct primary care or direct specialty practices about group arrangements for your employees. You might consider a hybrid model, a self-funded plan plus direct care, plus cost-sharing or catastrophic backstop. If you're a clinician, start learning about direct care models, start learning about transparent pricing, and start thinking about employer partnerships. Recognize that your patients are drowning in premiums, and part of our jobs as physicians is to help them navigate toward care that is clinically sound as well as financially survivable. Financial toxicity is real, and we are doing that to our patients when we don't know. So in closing, the removal of ACA enhanced subsidies and the resulting premium spikes are devastating for many families and businesses. They're exposing just how fragile and how extractive our current health insurance model really is. But this moment is also a wake-up call. We cannot keep pouring more and more money into a system that rewards profits over care, spends billions on stock buybacks and lobbying, and still leaves patients rationing medications, skipping appointments, and dropping coverage. There are alternatives: medical cost-sharing communities for catastrophic protection, direct care and transparent cash pricing for everyday health care, self-funded employer strategies that align incentives with health instead of profit. These options are not perfect, neither is big box insurance. They require education, nuance, and thoughtful design, but they put you closer to the actual transaction, your dollars paying for your care. My hope is that after today's episode, you feel a little less helpless, a little more informed, and a lot more empowered to ask better questions for yourself, your family, your patients, or your employees. You deserve better than take it or leave it. You deserve options, and those options are out there. I'm Dr. Arti Thangudu. This is Endocrine Matters. Thank you for listening and for caring enough to learn how to be a better steward of your healthcare dollars. If you want to learn more from me, please follow me on Instagram at Dr. Arti Thangudu, just my name. Same on YouTube. If you're interested in being our patient, you can find us at essaycomplete.com and make an appointment through there.